Hello and welcome to this edition of Insights. I'm Nilesh Munda and I have with me my senior colleague Mr. Prasanna Balachandar, who heads our markets group, treasury sales and research. I also have my colleague Pankaj Pandey, who heads research at ICICI Securities. Before I get into the conversation today on what's happening in the market and what are the opportunities, just a small beginning note. Uh, Let me quickly reiterate that sending money to India for all our customers like yourselves, those who are NRIs, is now more convenient and seamless with our M2I and SmartWire platforms. Making payments in India can now be done using UPI through international mobile numbers too, subject, of course, to certain conditions. To know more, you can visit our website or navigate to NRI Edge for more detailed information. Thank you, and maybe coming to specifically to our point of discussion today, what's happening globally as well as in India. So, Prasanna, I would like to start with you. As we all know, the world economy is going through a heightened tariff related uncertainty. Quite likely, the US equity and bond markets are kind of reflecting it in a particular manner that there could be certain probabilities of a slowdown in US, which is completely different from what we thought, let's say 3 months back, that US exceptionalism, which was the flavor at that point in time. So, from exceptionalism to a slowdown kind of conversation, how do you see things?
Yeah, so I think you're exactly right, Nilesh. We have seen a substantial shift in the narrative in the last, I would say, 1 month or so, especially post Trump taking charge, as opposed to post Trump win on November 5th. And the difference, let me try and elaborate. So I think US exceptionalism is something that has been very clearly driven by, in the past few years, by fiscal deficit, a very high fiscal deficit, a very high growth impetus from the migrant population in the US, very high consumption of US households because of the fiscal checks which was given to them during COVID, the equity wealth effect, which raised people's savings. And then, last but not the least, the reshoring and the near shoring kind of thing which happened during post-COVID era in the US. Now, if you look at the four pillars of Trump policy, I would describe it as, for whatever reason, describe it as tariffs, taxes, which is lower taxes, lower deregulation, and immigration. Now, some of the pillars are short-term positive, and some of it are, I would say, long-term negative. And initially, between November and February, I would say that the market was completely focused on the short-term positive factors, thinking that they'll worry about the negative factors later. But the way Trump has been going about, announcing policies, taking it back, announcing tariffs, taking it down, taking it up, the uncertainty has increased dramatically, which has led to the market thinking about or worrying about the long-term negatives right at this point of time. Now, what Trump is trying to do is something that some of us might agree, which is like, from his perspective, he wants to bring production back into the US, and he wants to shift US growth. He wants to shift the focus of the US growth away from government more towards private sector. Now, but the impact of some of the policies that he has done would obviously be that on the case of tariffs, for example, it increases US inflation by around, various estimates are there, 50 basis points as well. And this kind of tariff imposition also impacts consumer confidence. People don't know what is going to happen in the future for their jobs, for their companies, whether they're going to be remain competitive. And the kind of spending cuts by the Department of Government Efficiency also implies job cuts again would imply lower growth, deceleration of economic activity, and a weaker wage growth, which in turn will lead to lower private consumption. So, all in all, the policy mix is one of a stagflationary kind of a fear in the short term. And we are looking at even at the Fed, which has kind of raised inflation expectations and lowered growth expectations in the most recent policy, day before yesterday. So our assessment, Nilesh, is pretty much that the market is today fearing about recession is slightly exaggerated. We are more in the camp of growth slowdown and not as a recession. And we are looking at growth slowing down from around 2.4% expected to around 2% or just about less than 2%. And this is against a growth of 2.8% in 2024. So growth down by around 40-50 basis points. So the recession probability is lower because we do believe that the household and the corporate balance sheets are still very much solid. However, the weaker growth will drive US equity markets lower because it's been on a tear for quite some time. Tech stocks are facing problems. China has now kind of brought out models in AI at much cheaper cost than what the US companies are spending. So a lot of question mark is being placed on the kind of money that is being spent on generative AI. And last but not the least, also the fact that Make America Great Again policies, the way they have been announced, is kind of making people believe it could be Make Europe great again, because by delinking the US from a lot of protectionist policy that he was doing from Europe, now Europe has suddenly figured out they have to take care of themselves. So you can see a lot of increase in defense spending and fiscal spending. So all in all, I think what has happened in the last 1 month, I would say, is a redistribution, a little bit of slowdown in global growth, and even within that, a little bit of redistribution away from US growth towards growth in Europe, growth in China, and growth in emerging markets. Back to you, Nilesh.
So, and you kind of rightly brought in the point of Europe, which I would have anyways come to. So, of late, we have seen that dollar seemingly has peaked. The whole narrative that dollar is rising and now it has kind of fallen a bit, and at the same time, euro has risen. And quite likely, it is probably because of the point which you spoke about, this new thing, mega. I mean, from MAGA. So, so how do you see? I mean, so two questions. Do you think that dollar for from rest of world point of view has peaked and is likely to continue to kind of slide down? And within that, as a next question, maybe I'm kind of combining two questions. Do you think as a result, Euro USD and Europe has legs to kind of go up? European equities, for example, have legs to go up.
So I think a lot of what you have described just now has actually played out in the market already. You would see that the dollar index has fallen from close to 110 to it went even as low as 103 in the last week or so. Now maybe recovered a little bit. So that's a huge 7% change in the dollar index in a matter of a month, and that's big. And that has taken cognizance of the fact that the thing that I said about redistribution of growth away from the US towards Europe, and the fact that because of tariffs and because of inflation likely to be higher, there is also a view that the kind of rate cuts that Fed was could have done earlier is not going to happen right now. So to some extent, that is also leading to a kind of a growth negativity as far as the US is concerned. So all in all, I think US exceptionalism is kind of shifted to looking at Europe and looking at China. And yes, I think the policy response in Europe and China has completely reversed. If you look at the German parliament, for example, they have approved the fiscal expansion bill, which, coming from the US or from any other country, you might not think it's a big deal, but for the Germans, it's a real big deal. Because even in the worst of the crisis, whether it was in the global financial crisis or the 2013 crisis, they did not relent on the fiscal expansion, and they were very, very picky about expanding German debt, which is called the debt break. And they've allowed to break the debt kind of scenario right now. And they're really stimulating infrastructure expenditure, defense spending, not just in Germany doing it, and then the other countries are also realizing that they have to pick up the slack if the US were to withdraw from, let's say, NATO and the kind of protectionist foreign policy that US was having all the way. It just means that every region and every country will possibly have to take care of itself. So all historical policies like we will not will not expand our fiscal deficit and all is being thrown away. And each country in Europe is now trying to, get more spending its way into better growth. And also from China perspective, I think there has been more and more market-friendly measures which are coming in. So all of it is leading to fading US exceptionalism. So that is why the dollar has kind of fallen away. I would say that a lot of the move has happened. I wouldn't, I mean, unless there is also some speculation that there is a Mar-a-Lago Accord which actually can replicate the kind of Plaza Accord which happened in the 70s, which is to depreciate or devalue the dollar. If that were to happen, you would see the dollar index going even below 100. But the jury is still not out whether they are doing it or not. Outside of that, I would say a lot of the move has happened as far as the dollar is concerned. I would broadly say 102 to 105 is a kind of range. We're not going to see dollar going back to 110 unless some dramatic changes again happens. And I would say most of the bias of the weak dollar would be taken up by euro and by to some extent I think the Chinese growth will also do well because of the kind of market friendly policies that they have announced. I
Yeah.
mean, the caveat is, of course, Nilesh, that if there is a deeper recession, which we are not calling for right now, then you could get a risk off and you could see a safe haven trade, in which case money flows back to the dollar US and then the dollar appreciates. But we don't see that happening as of now.
Yeah. Like you said, I mean, there is this Mar-a-Lago Accord in Plaza. I think there's also this conspiracy theory which at times Twitter will, or X now, will keep saying that, they're probably trying to engineer a slowdown so that they can bring down bond yields substantially. I don't know whether that's true or not, but what's your view on US bond yields? I mean, do they have reasonable room to fall further?
No, so that sounds a little crazy that just because you want to get bond yields down, you're actually trying to bring down growth itself. But yes, I have also, been privy to some discussions which seem to indicate that. But looking away from the conspiracy theory, I think the way to look at it is number one, Trump 2.0 is focused most on the 10-year bond yield and not on the equity markets, at least initially. And that seems to be, suggested by the way they have justified a fall in equity markets and not really come and pump prime the equity whenever the equity has fallen. But they are more thinking in terms of diverting growth away from fiscal towards private sector, which in turn means that the US government spends less, which in turn means they borrow less, which in turn means the 10-year yield will come down. And also, I think their focus is on getting more rate cuts from the Fed, and hence that is also going to be, favorable from a point of view. If they are able to engineer it, then it's going to be positive for bond deals. So, to some extent, bond deals at one point of time, when it was at 465, 475, the 10-year bond yield, it was threatening to, run away even beyond 5%. And when Scott Bessent was appointed as a Treasury Secretary and the announcements came in and the fact that they are trying to bring down expenditure, what people thought were long-term benefits actually became short-term, which is the reduction in expenditure, the focus. And hence markets started, correcting and yields started falling down. And also now the fact that there is a growth slowdown in the US, even if you don't admit to a recession theory, you have to admit that now we are looking at a 40, 50 basis points lower growth, in which case, hopefully, even though inflation might go up due to tariffs, it might come down due to growth, means that the Fed will have some ammunition to cut. So the market is expecting 50 basis points this year, 50 basis points next year, and 25 basis points the year after that, which is implying a rate of around 3.25 to 3.5. And if you have to believe it, then a 10-year yield at 4.25 to 4.5 is quite attractive. And of course, if a recession were to happen, then you will get a further downside in yields, and yields can go even towards the 3%. All in all, I think if you believe, say, 2.5% as the inflation rate, then a 1% real rate of 3.5% on the Fed is very reasonable, and a 3.75 to 4% rate on the 10-year bond is reasonable. Anything above that is, if things become a little bit more darker on the growth side, then it's quite possible to have.
Okay, so there's value out over there as far as US bond yields are
Yes.
concerned at this point in time, and we can expect them to go down. And I think you already concluded, or rather, you have kind of laid down that base case is slowdown, not deep recession. Dollars. I'm just summarizing whatever we've discussed so that I can move on. Dollar quite likely has already fallen quite substantially and is expected to be in a range, neither go up too much nor kind of fall down too much, unless there is actually a deep recession, which we are not calling for. Um, Pankaj, you'll have to give me a little bit more time before I come to you. I think I have so much is happening globally right now that maybe more than India. I think we need to kind of put that context what's happening globally. So I have two more questions, Prasanna, before we come and discuss India. One is about this incessant rally that has happened in gold. Now it has broken all kind of historical correlations with interest rates, dollar, everything. I mean, uh, there is a suspicion that dollar rise is indicating something deep, which other things are not indicating. Maybe it could be just the that interest rates fall too dramatically or dollar falls too dramatically. So what is your sense? What has led to this kind of decoupling across all models as far as gold is concerned, and what's the view going forward?
Yeah, so I think you were right. Earlier, it used to be very simple. If you have to take a view on the international price of the gold against the dollar, you have to take a view on the dollar. And if you have a strong view on the dollar, then gold will depreciate and vice versa. And similarly, you have to just look at the link between gold prices and interest rates. And since gold is a non-interest bearing commodity, higher interest rates was negative for the gold and lower interest rates positive for gold. That's how we have traditionally moved gold over the last 20, 30 years. I think a terrific amount of dislocation happened in the last 2 years to 2.5 years. That is when, even when interest rates were going up, gold was rallying. And even when the dollar was rallying, gold was also rallying. And one of the reasons I think is the because of the decoupling was the fact that the kind of safety hedge people looked at in holding gold as against holding dollar, because there was a lot of de-dollarization which was happening post the sanctions on the Russian dollar reserves, which kind of led countries and central banks to believe that they're not safe if they're holding substantial amount of their reserves in dollar, and they shifted their buying away into gold. So that was one thing. And in general, there was a safety hedge because there was uncertainty on trade war. That also led to higher demand for gold, the geopolitical tensions, the central bank diversification, like I said, and the elevated public debt, which always means that the value of every unit of currency which is outstanding in a currency where the debt is very high, means that value is decreasing. So shift to gold, where you don't have outstanding gold increasing as much as possible in a year. A lot of what I said can be spoken about Bitcoin as well, but then that's a topic for a different discussion. And even exchange traded funds have also started buying gold recently in good amounts, because gold has proved to be an excellent diversification tool, and a lot of public savings has also got diverted into such kind of products. So I think from an international perspective, these were the reasons why gold did well. And for Indians with INR surpluses who are looking to deploy, I know we are speaking to the NRA community, but then they are also as exposed to INR as Indians are. And when you look at INR, the INR price of gold has a further impetus, which is the depreciation of the INR against the dollar. So I think all of these factors is what led to gold appreciation. I would still be a bull on gold for a little bit more time, and maybe another 5% up or 10% up, and then maybe it starts either cooling off or stabilizing. But I would say that the benefits of holding the dollar is still very much there, especially in times when US foreign policy is getting so one-sided and so uncertain, and people might not want to really depend on by investing in the dollar, because you really don't know what's going to happen to the reserves that you might be putting there. I think I'll stop there and give it back to you, Nilesh.
Okay, so I think I have a relevant question to ask now to Pankaj, who has kind of patiently listened to our interaction. So, Pankaj, considering the macro perspective which Prasanna actually, spoke about, which is the dollar has probably peaked and is likely to be in a range. The US is likely to kind of go through a slowdown, but not a deeper slowdown. And incidentally, yesterday's FII buying numbers, net buying, was a good 3,000 after like some many weeks or months, I guess. So, and as markets have, so do you think that the FII selling piece in Indian context is by and large done?
So, Dinesh, given the global volatility, it's difficult to say, but when you look at from a FI perspective, we have seen a sell-off of nearly about $29 billion in the last 6 months. And but our sense is that their relative positioning on India is no longer negative. And also, if you look at off late, the intensity of FI selling has definitely come down. And in a big sector like banking, which is nearly 35% of the overall Nifty index, uh, our sense is that they are no longer negative on a segment like this. So from that perspective, I think incrementally they are not turning negative. I think for them to sort of turn positive, we have already seen about 10% kind of a correction in US markets. US markets needs to correct further. And that is when I think the outlook for or the relative attractiveness of India will increase. And that is where we would want to believe that the FIs will make a comeback. But besides that, I think there are other factors which are going to help in terms of our markets doing well. So typically, equity market price performance is a function of two, three things. One obviously is the corporate earning growth. The second one is the macroeconomic factors, and the third obviously is the valuation. On the macroeconomic side, I'll come to earnings first. On the earnings side, see FY25 or 2025, overall the earning growth is expected to be about 4 to 5 odd percent, and this is largely one-off year because what we have seen is that we had about eight odd state elections. On top of it, you had Lok Sabha elections in FY25. And that led to a sort of a slowdown in the government expenditure, and that had a fair amount of impact on the overall corporate earnings. Now, with most of the elections behind us, this year you have only two elections. Delhi, we are already done. You have Bihar towards the end of the year. So our sense is that the corporate earnings are going to recover to about 14 odd percent, so 13% in FY26 and about 15% in FY27. And so earnings are going to sort of normalize. The other is from the macroeconomic factors. One, inflation is likely to remain benign. I think the core inflation has been below 4% for a good period of time. Then crude is down largely because of the global uncertainty and is likely to remain so. And then I think industrial commodities are also quite muted. The other thing is that we have already seen the GDP growth bouncing back in Q3. And on top of it, currency has largely stabilized. Going forward, the growth expectation is about 6.5%. So from that perspective, overall domestic macros have sort of improved. On the valuation side, since we have seen a fair amount of correction of about 15% from the top, the valuations have turned attractive. So on a forward basis, we are trading somewhere about 17 and a half times. At peak, we were at about 21 times. So valuations are in line with the historical range, and which we feel that that domestic macros and domestic valuations and earning growth is definitely going to support. And I think US market, given the way the tariff war or the tariff intensity or anxiety is still prevailing, some bit of a growth concern can remain there. And with further correction anticipated, it is possible that the FIs could make a comeback to our markets.
Okay, so maybe, I mean, you already answered what I was about to kind of ask, but anyways, I'll go back to Prasanna for an important part related to this whole FII thing. And Prasanna, when the whole FII selling started in end September, early October last year, one of the thing was that now China has kind of recovered, and maybe now some money has started to move to China. Then it kind of slid down and finally has kind of revived again, and something, this whole China tech, and now something being kind of referred in what I read in Bloomberg is Xi Jinping's put, while we have heard of Fed put and all that stuff. So, is that a factor in the reckoning as far as flows are concerned and relative preference of China versus India for the time being, in context of what Pankaj said?
Yeah. So I think in the last 1 month to 2 months, I would say that the flight away from emerging markets to the US has reversed. And global money is now coming out of the US and going into areas like Europe and Germany and China. And of course, it has still not found its way into Indian shores, but we'll have to wait patiently for that. But yes, the key difference between China then, which is China, say, 3 months ago or 4 months ago, and China now, is that I think earlier it was looking like just a tactical trade. People wanted to do it from purely from a market's perspective, that you get in and get out and treat it like a trade rather than as an investment. But I think what has now happened is that President Xi's policies definitely seems to be much more market friendly, and they seem to be doing things to encourage investors to come into the economy and kind of stick with them. And that's the reason why you would have read the sheep put or whatever. So I think government has also announced a fiscal stimulus close to around 1% of GDP in quarter four. That kind of revived the economy, and also you had a front loading of export orders that are taking place in quarter four, probably to beat the tariff. So I guess the story is somewhere in between that. The entire recovery that we are seeing in China is possibly a little bit of it is due to front loading, but at the same time, it is also because of the fact that China has done a few governmental policies which are, favoring. Property sector also is showing signs of bottoming out. But again, infrastructure spending seems to be the focus of the policy support there. And I think there is a good possibility that around 1 to 1.5% of GDP resulting from fiscal policy of the Chinese government is good to, kind of offset the impact of softer exports and a slowdown in the economy, that if it is kind of being moderate. High frequency indicators, if you really look at it, is showed that the cyclical rebound is actually continuing when you look at retail sales, industrial production, infrastructure spending, etc. But also bear in mind there could be some kind of seasonal pickup in the fact that the Chinese lunar holiday just crossed by. Structural weaknesses still are there in China, along with the kind of improvement in high frequency indicators. But like I said, since the President Xi has turned increasingly business friendly, encouraging technology investments, and the Chinese have also shown much cheaper way to spend in AI than the kind of generative AI than the kind of billions of dollars that American tech companies are spending, has actually led to a lot of concern in terms of whether the American companies are spending too much to achieve too little, because the spending is real, the benefits is still not very clear. But whereas on the other hand, China is showing methods to do the same with far lesser spending. So all in all, I think China has come back in a very strong way. And I think as far as India is concerned, we would need to maybe show confidence to the foreigners by having a earnings growth revival, which kind of proves that the downturn of the last 2 quarters were more cyclical rather than structural. If that were to happen, then I think India will also start to get a fair share of the flows that are coming into emerging markets.
So yeah, so I think that's a fair point, and you spoke about the fact that the cyclical slowdown that probably we had got so used to in last 5 months or so. So if it was really cyclical, what is your sense, Prasanna? What led to it, and all those things are reversing? So Pankaj spoke about that macro data has started to kind of get better at the margin, and I'll come to him. What's your sense? I mean, how things are moving in as far as India is concerned now?
So when quarter two GDP came at 5.4%, that's when the slowdown fears started. Maybe just a little bit before that, when earnings commentaries and other things started getting a little bit downbeat. That's when the cyclical slowdown fears started, and the earnings growth fears happened. And if you have to look at what drove the growth slowdown and the fears, I think I would describe it as a mix of consumption slowdown and investment slowdown. Investment slowdown was primarily on account of the government spending, which was reduced completely in quarter one and quarter two on account of elections and so on and so forth. And the capex, while even if they did the budgeted expenditure on a Y-on-Y basis, the capex growth was not as high as what it was earlier, which is just not possible because we have reached a level where the capex growth by the government is going to level off. So that is one reason. The second was a consumption slowdown, which is also happening because of the wage growth in the listed corporate space being sharply lower than what it was a year ago. And also the IT sector's net hiring actually kind of, remained in the red in quarter 3 and quarter 1 of FY25. And they also, kind of led to some kind of concerns as far as muted wage growth is concerned and reduction in IT workforce and so on and so forth. The third important reason was the fact that you had the RBI's policy being a little bit tight towards not just liquidity, but also towards protecting the rupee from depreciating. They kept it quite appreciating even when dollar was, appreciating. The rupee was very strong, which effectively means it's a tightening the Indian economy. And also, I mean, like I said, liquidity, since RBI was intervening and keeping liquidity tight, and also changing risk weights on credit growth, unsecured loans, and NBFCs. All of this is what led to substantial amount of tightness. Now, on two fronts, we can see substantial change. First is RBI. RBI has changed decisively, I would say, in the last 2 months, post December mid, where they have now started letting the rupee depreciate. That is, whenever dollar appreciates in the global markets, the RBI is not letting the rupee, not preventing the rupee from depreciating. They're kind of letting it go as per market forces, which is very important, and also giving as much liquidity to the market as possible in terms of compensating for the kind of tight foreign exchange policy that they were having. And to put it in number and put it in perspective, including the announcements which are still outstanding and they're going to execute, they're going to give 6.5 lakh crore of liquidity. Most of it is to replace the lost liquidity, yes, but then the fact is, with all this money coming in, our core liquidity situation has actually gone from negative to positive. And they also turned in their February policy to cut rates for the first time in 2.5, 3 years, which is also a significant change. And I think the moral aspect of persuasion of trying to tighten the economy by increasing risk weights, they've also slowly, turning it down. So from all this perspective, the policy prescriptive is also getting a little bit easier. So these are all likely to become a little bit on the tailwind as far as India's growth is concerned going forward.
Okay. So, Pankaj, a related question now, and you spoke about the overall macro environment and the fact that things are looking better and earnings growth especially. So, in that context that we've discussed so far, do you think that our markets at maybe 22,000 Nifty had made a bottom? Do you think so? And maybe we are well past it comfortably now? I know it's a tough question, but yeah.
So, Nilesh, after Nifty corrected about 15 odd percent from the top made in September, you've seen a bounce of about 5 odd percent. Historically, the fall in the market happens almost every year, can happen multiple times in a year, because market continues to price the risk which emanates from various factors from time to time. This time, the risk is from tariff war and its impact on various economies and the consequent growth impact. So our sense is that historically, since 2006 onwards, the average fall in the Nifty 50 or mid cap 100 or small cap 100 has been in the tune of about 27 to 30 odd percent. And the duration of this fall is somewhere about 7 to 8 odd months. Typically, the corrections are larger when there is a bear market or when you have a situation like, say, 2008 or 2020 when COVID happened. But our sense is that we are not in that scenario. So from that perspective, we have already seen 6 months of a market correction. So I think time-wise, we are closer to the bottom in terms of time-wise. From a price perspective, see, the mid-cap and small caps have already corrected about 20 to 24 odd percent. So I would want to believe that we're closer to the bottom. It's very difficult to say whether we have made a bottom because I think we still don't have enough clarity in terms of the kind of tariff Trump is looking to put on India. So that may cause some bit of volatility, but my sense is that time-wise, we are closer to the bottom. Price-wise, in case if something turns worse, probably one should be mentally prepared for 5 to 7% kind of a correction further in the markets.
So 4 to 5% is okay when you've already gone 15%, right? I mean, that's not too much. So, I think this is an important point that you touched upon. That look, the downside clearly comes from the fact that there is still tariff out over there. Quite interestingly, I mean, and it's quite confusing also, Prasanna, that we thought that Trump is levying tariffs on the world to kind of make America great again, and I think now, as it looks like everybody else is fine and America is under problem. Right? And so, do you think, like Pankaj is saying, that at some point in time, there are two views, of course, the uncertainty part, but then there is another view that India could be relatively much better placed as far as tariffs are concerned. Already, a lot much of work is happening, as it seems, with respect to trade agreements, etc. So, what's your sense? Could India be relatively much ring fenced from tariff impact if it were to happen?
I think, yeah, the belief. See, the funny thing about international trade and global trade is the fact that it is all a relative theory. I mean, if you are badly affected, but if you are less badly affected than some other countries, then you are actually better. So I think that's the irony of the whole thing, and the futility of doing a full-fledged analysis is also that you can never come to a proper conclusion till you actually see the data and see how it's actually figured out in real world. But the broad philosophy, I would say, from an Indian economy perspective, is that we are more domestic consumption driven rather than exports driven. That is the first point. Second is the fact that services, GCC, and IT, these are the significant growth drivers as far as exports are concerned. And they're all exports of services, which are thankfully not touched by the US tariff regime at all. And trade exports into US is just around 2.4% of India's GDP. And when you talk of the differential tariff between what we on an average are imposing onto American goods and what America on an average is imposing on our goods, the differential is around 9%. And we have done some calculations to indicate that there is an historical elasticity of export import by around 1.5%, 1.5, and hence impact of a 5% differential tariff will lead to somewhere around 0.2% of GDP. But that is assuming the historical elasticity holds true. It's quite possible that the elasticity can be different, lower this time because of the fact that the tariff is not only being put on us, but also put on a lot of other countries. For example, South Korea has a much higher differential tariff. It's at 14% differential, whereas we are only at 9. So to some extent, I think South Korea will be impacted much more. And so you can go on and on like this. So it's quite possible that India will be less badly affected, which can turn out to be, better. The downside scenario for us is around 0.2% of GDP.
Okay, that's okay. So, Pankaj, I mean, I'm intrigued by one question which has been put up by one of our participants about this whole lake theory that is being propounded by one commentator in media, right? I'll not name, but as we know, the whole theory is all about that, in Indian equities or in equities, there's a finite return that you have, and as the lake kind of gets empty, it takes time to refill and things like those. So is there any now we have had 5 years of very good equity markets, of course, till 6 months back. And prior to that, 5 years were like okay types. So the theory says that maybe, next few years could be a bit volatile, difficult, not very rewarding. What's your sense? Is there merit in kind of associating too much to the lake theory?
I think, if you look at Nilesh, what we are experiencing at this point in time is quite unprecedented. The biggest issue with tariff is that two of the biggest economies, which is US and China, are engaged in a tariff war, and there's still not much talking. So this has the potential to sort of bring down the entire global growth and can cause the inflation to go up. Unlike the earlier scenario where you had a lot more trade negotiations and the environment was a lot more conducive. So from that perspective, I think things are definitely changing. And now, as Prasanna also highlighted, relatively for us, our sense is that we would be a beneficiary of the a relative trade tariff. So from that perspective, I think there are some pockets which we are which are going to experience a lot more better growth. Economically, also since we are domestic driven, so overall sense is that the GDP growth rate of 6 to 7 odd % is expected to sort of sustain. Ideally, it should be more than 7%, and with nominal overall GDP growth rate is expected to be 13, 14 odd %. So that kind of a growth is very difficult for any of the global economies to sort of achieve. And which is why we feel that India can be in a sweet spot for a good period of time. And coming to sort of some of the impacts, what we see from tariff. So one is like Prasanna highlighted. IT is one of the big sectors where we don't see the much of an impact on tariff. So of late, what has changed is that there has been an expectation of a sort of a global or a slowdown in US, and potentially that could delay the recovery of some of the tier one IT companies, largely because the discretionary spending will sort of come down. But overall sense is that some of the sectors like pharma, you really do not have an alternative to sort of look at. So since we are more of a domestic driven economy, I would want to believe that we could be sort of decoupled to some extent compared to what will happen globally.
Okay. So maybe two quick questions before we kind of take few client questions. Although one, this lake theory I've already taken. So Prasanna, do you think, and since we have some of our NRI customers as well over here, um, and when we look at data on a relative basis, INR has significantly outperformed this whatever has happened. Like, it's not fallen as much from 84 to maybe 87 and a half, and now back to 86 or something like that. You think the worst part of volatility linked to the global dollar bullishness is past, and therefore now it will be more moderate selling for the rupee?
So I think the way to look at it is the initial part of the dollar appreciation when it went from 103, 100 to 110 was kind of leading to a lot of depreciation of euro, GBP, Chinese yuan, and all that. And that was the period when INR did not depreciate as much. And what it was leading to was a significant amount of rupee overvaluation, which we measure by RER. RER is supposed to be, if you're fairly valued, supposed to be at 100. And RER takes into account the different nominal exchange rates and the differential inflation between various countries. And we were getting higher inflation, which basically means we should depreciate. And the dollar was appreciating against every other currency, which also means that we should depreciate. But then we were not depreciating enough because at that time RBI was holding the end quite appreciably. But what this led is to tremendous amount of overvaluation, and at one point of time, our overvaluation went up as much as 8%. RER would have been in the region of 107 to 108. But now, when the dollar reversed and came back from 110 to 103, all the other currencies have appreciated because they depreciated in the first place. But the INR never depreciated first, so we have not appreciated as much. Yes, we have gone from 87.5 to 86.5, 86.20, 30 as we speak. But the fact is, we have appreciated much less. And I would say this is a payback of the lack of depreciation in the first place. So we have kind of caught up with valuation. We are now back to a RER of around 103, 103, 103 and a half, which basically means our overvaluation is down from 7-8% just to around 3.5%. So the long story cut short, what we are trying to say is fundamentally the rupee has to depreciate by around 1.5-2% per annum because of inflation differentials. So you have to prepare for a rupee depreciation over a period of time. The good news is the kind of concern that people were having on rupee breaching 90 and 92 and things like that, basically because of the strength of the dollar, that has gone away. The dollar weakness is kind of put weight to those kind of fears. But on the other hand, do you think the rupee will have to continue appreciated from that perspective? But as always, Nilesh, no amount of, none of us are know the exact picture because there are just too many moving variables. One is, of course, the US tariffs. The other is, of course, other countries' reaction to the US tariffs. And then the third is the way central banks react to changing dollar INR. So all of this put together, it's virtually impossible to give a long-term view and be confident about it. So, but right now we would stick to a view of 85.5 to 87.5 kind of a range and the limited rupee appreciation, but gradual rupee depreciation.
Yeah. So, Pankaj, I mean, in the end, from an equities market point of view, of whatever we have discussed, including dollar INR volatility, maybe when I look at last 5 years, of course, they've been exceptional, but last 10 years, 12 years, 15 years, in general, dollar adjusted returns have been fine, at least, in line with what is available, and maybe more less volatile of late. So, and that's what, so, you were also kind of trying to allude to. From a 12 to 24-month point of view, what do you think are the best opportunities in India, and what are the things that you would want to certainly stay away from?
So, Nilesh, so if you look at from a sectoral perspective, BFSI is one of the biggest sector. It typically contributes about 40-42% of the overall Nifty earnings, and it's a very important sector from an economic perspective as well. And so this segment was facing some bit of asset quality concerns in certain pockets of unsecured retail segment. And but what we have seen is that there has been change across. So this is one of the few sectors which is expected to deliver very healthy performance. There has been liquidity infusion by the RBI. Then we have already seen 25 bips kind of a repo rate cut. A further 50 bips kind of a rate cut is very much possible. Then there has been some reduction in the risk weightage for exposure to NBFCs. Then the overall sense is that next 1 or 2 years, you'll see a far more normalized credit growth for this sector in the range of say 12 to 14 odd percent. And I think the other part is that GDP is sort of reviving, and there is a revival in the overall government capex. So BFSI is one sector which is really good, looking good from both valuation as well as growth perspective. And now the other is capital expenditure. Now, capital expenditure as a theme has been sort of written off. It seems people think that post budget consumption is a theme. But our sense is that capital expenditure as a theme is going to remain or will remain relevant for a good period of time, because we need to grow at 7% to provide enough employment opportunities for the young population at large, which we have. So within that, we like capital goods, defense again, ordering overall is expected to pick up. Government is now signaling procedural changes in terms of a faster execution of things from acceptance of necessity to ordering. Then cement and steel again, cement is consolidating. Prices are at a 1 year low. Steel industry is getting some protection from the kind of dumping what we have seen. And then on top of it, power is another sector which is extremely important from a energy autonomy perspective, because whether you look at the electrification of auto or you look at the kind of data consumption which happens because of in mobile, there is a good amount of requirement for data centers. So power is again one of the themes which we like for the next decade. It is going to be fairly relevant. In consumption, we are very selective, so only the premium leg is what we like. So, for example, hotels and hospitals or selective autos are looking good. If I have to ask, or if I have to sort of name one more segment, then I think in healthcare, besides hospital, we like CRAMS or CDMO as a space. Largely because our sense is that a lot of big opportunities will get created in the next few years, right from passage of Biosecure Act or to the perspective of the US biotech funding improving. Now, coming to some of these segments which we don't like, so IT is one of them, because see, IT growth rate this year is about 5.5% in terms of dollar revenue growth. Was expected to improve next 2 years. But with US in kind of a tariff war with other nations, I think this growth is going to sort of get pushed. And combination of rupee depreciation plus dollar revenue growth, I don't think it is going to deliver double-digit kind of a growth rate. And I think same is the case with FMCG. Both permutation and combination of price and volume is not likely to give them double-digit kind of a growth. On top of it, the valuations are still rich in consumer staples or FMCG as a segment.
Okay. Um, I think before we end, one, I would say, eternal discussion that we have had is large caps versus mid and small caps in general. And Prasanna, Pankaj, as you know, we have kind of discussed it threadbare for like almost 2 years, and finally, in the last 6 months, we have seen a bit of reversal over there in mid and small caps. generally from an index point of view or from a fund point of view. So I think there are questions around that as well. What's your sense? I mean, is this something? So as we say, large and flexi or diversified as a space is best to kind of focus from allocation, incremental allocation point of view, and generally mid and small caps to avoid. Is that the base view that one goes with? Or like Pankaj, you said that there are specific opportunities which one can play through direct stocks, or it is both. Maybe Prasanna and then Pankaj.
No, Nilesh, I'll let Pankaj answer this.
Sure.
So, Nilesh, from a correction perspective, Nifty has corrected by 15 odd percent, mid cap about 20%, and I think a small cap about 24%. So, some bit of a correction can happen across all the three segments. Now, which segment to choose for? I think it is a more of a function of risk appetite than anything else. Largely because, see, if the domestic economy does well, it does benefit the entire leg of the market. So, whether it is a large cap, whether it is a mid cap or a small cap. So, again, it becomes a function of the kind of a risk appetite one carries or the kind of risk appetite they are willing to sort of digest over a period of time. Our sense is that there are some themes where you really do not have large caps. I mean, just to highlight, for example, in a segment like hotels, you have only one large cap, rest everything is small cap. Similarly, look at hospitals, you have only two or three large caps, rest everything is small caps. And these are extremely important segments of the economy, and that is where a lot of premiumization is being driven also. So my sense is that since our perspective is that next few years the entire economy is going to sort of do well overall, so it becomes more a function of what kind of risk appetite one is willing to carry. So if you are new to the markets, then I think large cap is the area to sort of look at, because it is difficult to digest the kind of volatility mid caps and small caps carry. But if you are fairly well versed with the markets, have seen cycles, then I think, and willing to take risks, then I think mid caps and small caps. So no straight answers, but I like all the segments.
So you're saying you decide. Uh,
Yes, sir.
and okay, so I think fairly interesting, and I think to conclude, quick summary of what I learned during our last 1 hour of 55 minutes of conversation. America's pain, some bit of pain over there is maybe rest of world's gain, and to the extent India also probably benefits out of it, or at least it's not a, big problem anymore from an FII flow or dollar or INR point of view. Dollar INR again back into the same normal volatility range with a mild downward bias. Gradually, one has to account for. Things are getting better at the margin as far as India is concerned from an economic point of view, and maybe like Pankaj you said that GDP growth being 6.5%, and I think Prasanna also kind of agreed with that point of view. So maybe that 12-14% kind of earnings growth is something which one can expect going forward, and valuations are now fine. So to that extent, I think Indian equities, Indian fixed income, Indian rupee per se all look to be in reasonably good place for an international as well as for a Indian investor to look at, right? That's the summary of whatever we discussed. And my sense, Pankaj, all the sectors that you spoke about, they're available as one-click portfolios on the ICICI Direct portal. In case anybody wants to kind of place specific stocks through all the portfolios that Pankaj spoke about, you can kind of go there, click on one-click portfolios, and you'll get a lot many variety of options available, which are already curated portfolios. Thank you so much, Prasanna and Pankaj, for your time. Very interesting conversation at this juncture when there's too much of volatility. I'll request all the participants to before they sign out, there'll be a feedback form that will appear on your screen. Request if you can take some time out and share the same with us. Thank you. Wish you all the best.
Thank you so much.